Welcome to the Buffett Vault, where we cover alternative and unique investment opportunities and assets for 2025. Today we'll look at some of the worst financial investment decisions you could have made in 2024 from around the world. From the global luxury market to art and whiskey to real estate, let's dive in. Starting off with the worst, Latin American financial markets have struggled significantly in 2024. Equity markets in the region have experienced substantial declines, with Brazilian indices falling around 25%, primarily due to the plummeting value of the Brazilian real. The real lost 28% of its value against the US dollar over the course of the year. The currency woes were not limited to Brazil. The Argentinian peso also depreciated by 27%, while the Mexican peso dropped 18%. Venezuela's bolivar currency continued its precipitous decline as well. Overall, the combination of weak equity performance and currency crises has led to a very challenging year for Latin American financial assets. Argentina's economic reforms under its current leaderships have been painful. Inflation has plummeted and bond prices have risen, but unemployment has soared and poverty rates have surged. While monthly inflation is down, annual inflation remains close to 200%. The government's fiscal austerity measures are having an impact, at least from a top-down perspective. However, on the ground, the country is in deep trouble. The president has slashed funding for universities, pensions, public works, and cultural programs. This has led to a 20% drop in consumer spending over the past year, and poverty rates reached a two-decade high of 52.9% in the latter half of last year. The single-minded focus on reducing inflation is working, but economies are complex systems. Actions taken in the capital can have significant ripple effects across the country. The battery and energy storage industry has experienced a slowdown in growth following a period of rapid expansion in the electric vehicle sector. This has led to an oversupply issue with the battery industry. The performance of the energy sector and materials ETF reflects the current challenges facing the industry. The increased efficiency and lowered cost of solar energy have been a significant win in 2024. However, this has also led to reduced profits for producers and manufacturers. The commoditization of solar panels in particular has caused share prices to drop as capacity and production has increased. Many clean tech funds are heavily invested in manufacturing companies, which is problematic. Manufacturing commodities, even with advanced technology, puts companies at the low profit end of the value chain. This smile curve applies to various commoditized products, from solar panels to coffee machines. As long as most clean tech fund investments are focused on production, it will continue to be a challenging environment for investors. Additionally, the incoming American president's policies are also contributing to the downward pressure on clean tech prices. The EV, future transportation industry, has been facing strong headwinds, with the growth slowing down year over year. The self-driving ED and tech ETF is down around 14%. The clean energy industry experienced rapid capacity growth and declining costs in recent years, riding the wave of broader techno-optimism from 2020 to 2022. However, this trend was disrupted mid-2022 as interest rate hikes began to hurt the industry. The global clean energy ETF by BlackRock has shed 38% of its value since March 2022. As of 2024, the solar industry has faced worse than wind, the Invesco Solar ETF down 25%. Several segments of the oil and gas industry have seen negative year-to-date returns, with natural gas being hit the hardest. The Ultra Bloomberg Natural Gas Index Fund has dropped around 60%. The U.S. oil and gas industry has underperformed the global industry by 5.28%. The oil and gas equipment and services industry has also suffered, with the U.S.-focused SPDR Oil and Gas Equipment and Services ETF falling 7%. The natural gas sector has experienced a more pronounced downturn in 2023 and 2024 compared to other oil and gas segments. This is primarily due to dramatic decline in natural gas prices caused by global oversupply, mainly driven by high production levels in the US. Between 2014 and 2021, Japanese whiskey experienced a remarkable 600% surge in popularity. However, this meteoric rise has since given way to a significant decline. Since mid-2023, Japanese whiskey, along with most other whiskeys, has been in a freefall. In 2024, premium whiskey bottles, those priced at $1,000 or more, saw a 32% drop in sales. This trend reversal can be contributed to a confluence of factors. The Japanese whiskey market has experienced rapid expansion in recent years, but now shows signs of reaching saturation. Demand is starting to weaken as more brands enter the market and consumers become familiar with the product's availability. The initial scarcity that fueled much of the category's popularity has diminished to a normalization of sales. The global whiskey market is experiencing a decline, which is reflected in the value of various whiskey-producing countries. Scotch whiskey exports saw a 20% drop in volume during the first half of 2023. Irish whiskey exports saw a 14% decline in value for the full year. U.S. off-trade spirits sales dropped 4.7% from January to November. These figures indicate a broader trend of declining sales across the global whiskey market, including the Japanese whiskey segment. In 2023, Japanese whiskey exports declined, ending a 15-year growth streak, according to official data from Japan Customs. The total volume of whiskey exported decreased by 9% to 12.9 million liters. Additionally, the total value of whiskey fell by 10.7% to just over 50 billion yen compared to 2022. Suntory, a major player in the industry, raised prices across its entire product line. Some bottles saw their prices double. The whiskey collector's market has slowed, with auction houses reporting a 30% drop in price for rare bottles. This suggests a shift in consumer behavior, moving away from speculative buying and towards purchasing for consumption. Additionally, the rise of other premium spirit categories, such as mezcal and tequila, has taken market share from whiskey. Manchester United endured a dismal 2024 season, both on the field and off. By Christmas, the team languished in the bottom half of the Premier League table, and their stock had plummeted. Their crosstown rivals Manchester City also struggled significantly. In the sports collectors market, the lingering effects of the pandemic continue to plague niche sports card collectors. In 2024, the majority of card ladders indices experienced double-digit declines, with the exception of baseball, football, and tennis cards, which saw single-digit gains. Pokemon cards, on the other hand, saw a respectable 10% increase. Interestingly, the price of all wine products dropped in 2024. Additionally, all 12 LiveX indices recorded losses over the course of the year. The global luxury market has underperformed the broader market in 2024 due to a mix of short-term and long-term factors. Major luxury brands like Louis Vuitton, Burberry, Kering, and Lanvin reported double-digit declines in key growth metrics early in the year. The primary driver of this downturn has been slowdown in China's economic growth. China accounts for 35% of global luxury consumption. The World Bank projects further decline in China's economic growth in 2025, despite a temporary boost from recent monetary stimulus. Profitability in the agribusiness industry has been declining. Despite a temporary increase in 2021 to 2022 due to rising commodity prices, the Russia-Ukraine war was a key factor in the gain supply constraint that led to price increases. According to USDA projections, net farm income is expected to fall by 6.8% in 2024 on an inflation-adjusted basis. Decline was steeper from 2022 to 2023 at 19.5%. This moderate decline in 2024 is attributed to improved performance in the livestock market and slight projected decline in total input costs, though they remain high. Labor costs, a core input cost, are expected to continue putting pressure on farmers. Livestock receipts are projected to rise 7.1% in 2024 due to stronger than expected prices, while crop cash receipts are expected to decline by 10%. Direct government payouts, which have historically provided a safety net, are also expected to decline by 15%. In summary, the agribusiness industry continues to face profitable challenges, with rising input costs, including labor, and declining government support, despite some improvements in the livestock market. Banksy's artwork has proven to be a risky investment. His limited edition prints saw a 200% increase in value from 2020 to 2021, but then dropped by 25% in 2024. According to the Banksy index on MyArtBroker, his pieces have declined by 62% from their 2021 peak. This volatility suggests that Banksy's work may not be a reliable investment for mainstream collectors. In 2024, the 7 worst performing real estate markets in the United States were located in Texas, Florida, and Louisiana. The reasons for their poor performance differ between the two states. Texas was adding housing at a rapid pace, significantly increasing the supply and driving down prices. Florida, on the other hand, faced a different challenge. Homes in the state were increasingly uninsurable, which reduced demand. This also impacted the supply, as only insurable homes could be considered part of the available inventory. Mortgage REIT industry is the one industry in the broker real estate segment of the US that has been hit the hardest by high interest rates. That is because, other than investor capital, borrowing is what mortgage REITs rely heavily on to buy mortgage-backed securities. So that's all I've got for today's video. Next video, I'll cover the best investments of 2025, so be sure to subscribe and also check out mechanicstraders.com to begin fully automated passive income generation via my Forex MT5 EA.